China's banks right now are quietly preparing for a major liquidity crisis. They're dumping billions of yuan into the market. But wait until you find out what they're buying and why. It's a clear indication that the global manufacturing sector is about to crash and take the banks right down with it. Plus, tonight's show is brought to you by Mindwalk Holdings. You can find them on the NASDAQ and the symbol HYFT. And they just announced a major advancement of their AI-designed therapeutics program. And stock right now is sitting right on a 6-month volume profile. This is one trade you don't want to miss. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now, I want to show you what the Chinese banks are doing, why the PBOC is behind this, and why it means we're on the cusp of a massive liquidity crisis, one they don't want anyone to know about. As China's state banks shift dollar swap strategy as yuan gains. Now, this doesn't make any sense because right now the PBOC is injecting liquidity into the Chinese banking system. So why all of a sudden would they be taking that liquidity and dumping it on the market and turning around and buying dollars? Well, if you think there's a major liquidity crisis and you want something very liquid that could appreciate in value, well, it starts to make sense. The lenders have been ramping up their purchases of spot dollars over the past few months and offering large amounts of dollars for yuan in the currency market. So this is interesting. This has been going on for the last couple of months. Now, you may recall from yesterday's show, we talked about the purchasing managers index, and what did we see? In April, things started to roll over. So if we go backward, you can start to make sense now why they've been picking up dollars over the last few months, because China is on the beginning of any downturn. You know, they are the global manufacturing hub. So when there's a slowdown, it impacts them first. And right now, they're trying to get ahead of it. Now let's talk about a swaps market, because if you're not familiar with it, what's happening here is the banks are selling yuan and they're getting spot dollars, and then they're going out to the swaps market and they're dumping those dollars in large volumes. And what they're doing is they're exchanging it for yuan. So on the headline, it seems, well, they're just balancing the trade out. But when you do a swaps trade, well, what you're doing is you're committing to buy it back in about 3, 6, 9, maybe even 12 months. So they're dumping dollars in the short term on the swaps market to buy the yuan back later. And this is a very clear indication they think the yuan is going to weaken and the dollar is going to appreciate. But the real story of what's going on here is much bigger than that. This is just what the market wants you to think is going on. They don't want you to realize that the banks are preparing for an outright catastrophe. Although the two positions should ultimately balance each other out, the strategy is seen by traders as a negative for the yuan since it front-loads selling pressure. It wasn't immediately clear what prompted the banks to sell the dollar in the swap market, unless this is what the PBOC in Beijing were hoping to happen. And that's the real issue here, is they're very quiet, is why are they doing this? What's really going on here? And the issue is, if you really think about China's economy, we're going to talk about that in a moment. The real issue is the banks are under severe amount of stress. And what you see from PBOC and from Beijing is they don't want to be on the hook for bailing the banks out again. Because what happens when a government goes in and bails out banks? Then you get bank runs and the whole system starts to topple. Let's go back to September 21st, because China's central banks were reviving their liquidity tool before the long holiday. And I want you to understand that this is business as usual. And before every holiday, the PBOC steps in and they inject liquidity into the banks to make sure there's enough money. And in exchange, what they do is they take some short-term government debt and then they swap it back at some point in the future. But the real issue is this isn't a short-term issue, because for months now, the Chinese banks have been buying dollars on the spot market and dumping them into the swaps. So if you think about it, where's the issue with the dollar right now? Well, it's gone down a little bit in value. So there's some pressure here that the banks are making a bad trade. But on the outside, looking in, nobody would suspect anything's going on here. And that's what I really want you to understand. There's a major motivation behind these Chinese banks dumping all this yuan on the market, and it's everything to do with their economy. But while China's banks may be signaling a crash coming, something we're bullish on, that is the stock for our sponsor today, Mindwalk Holdings. Again, you can find them on the NASDAQ and the symbol HYFT. Let's take a quick look at their stock chart, because I want you to see it's sitting right on its 6-month volume profile. That's that red line going across your screen, and that is a bullish indicator. That's something we use in our trading reports every day. And again, this is one trade you don't want to miss. Stay tuned to the end of the show or check out the pinned comment or description for more information. The People's Bank of China on Monday pumped in almost 300 billion yuan, that's 42 billion of US dollars, into the banking system via 14-day reverse repurchase agreements, an instrument it last used in January. And that came alongside a 241 billion injected through a 7-day reverse repo. Now we're talking $541 billion worth of yuan injected into the banking system. And all this, again, from the outside looking in, providing liquidity for the holiday to make sure that when consumers go to the ATM and they have cash. That's all this is about. But what I want you to understand is the use of 14-day reverse repos will be more flexible in the future and won't be restricted to pre-holiday periods. So the PBOC is already coming out and saying, hey, look, we're going to continue to inject liquidity into the banking system, which clearly doesn't need it because they're out buying a whole bunch of dollars right now. And upcoming 14-day reverse repo injections underscore moderately loose monetary policy. Again, there's the official position, but note, they continue to dump yuan, and this gives them a tool to do it by injecting yuan into the banks. Because when you start to really understand what's going on in the global economy and the Chinese economy, the risks right now are to the banks. Because if something were to start collapsing, what's going to happen is the banks are going to be at the forefront of this, and they're going to need liquidity and a ton of it. And I can tell you right now, governments do not want to be on the record of bailing out banks. It reverses a previous strategy used by banks for much of the past 2 years when lenders were mostly borrowing dollars via swaps while simultaneously buying yuan in the spot market, and that helped boost the Chinese currency. But again, we come back to those flash PMI reports from the S&P Global, and what did we hear? That there were indications that new orders were dropping off of a cliff. Now this means it's going to impact China and every major economy. So as we look at China's economy, what do we see? 35 straight months of declining prices in the factory sector. That's called deflation, and that's a major problem. Remember, Beijing stepped in and said, look, we want to stop that. But what about the property sector? I've done a ton of videos on how the property sector is over leveraged and the banks have lent massive amounts of money to them. If property prices continue to fall, and it looks like they're going to continue to do that, the banks are in a dangerous situation of needing liquidity. You've got high youth unemployment so high the government doesn't even want to report it, and then you've got tariffs. You know, the trade war isn't quite over yet. And state banks trading swaps could either be an unwinding of previous buy-sell swap positions or efforts to curb overly rapid yuan appreciation. Again, this comes from Becky Liu. She's the head of Chinese macro strategy at Standard Chartered. So again, you hear other people speculating, saying, look, this is just business as usual. Nothing really to see here. There's nothing really to be concerned about of why Chinese banks are out buying massive amounts of dollars over the last couple months. That is unless you believe the Fed rate cuts aren't bearish for the dollar. Now keep in mind, that is the prevailing opinion among every investor all over the world. Now we know that's not true because when there is a liquidity crunch or financial conditions tighten up, there is a run to the dollar. So it gives you some indication that China's banks are saying, look, we know what's coming. We think the dollar is going to rise in value here and maybe over the next several months. Or perhaps there's something else they're doing with some of those dollars, because if you think the Fed's going to cut rates, well, what would you like to own? Well, you want to own treasuries, but can you buy it with yuan? No, you can't. You got to have dollars. And what have we seen from the latest foreign data is on treasury holdings is that foreign investors are buying a record amount of treasuries. So it starts to make sense here. The banks could be taking those dollars. We know they're putting them out in the swaps market to say, look, we think the dollar is going to go up in value. But if they're taking some of that money and buying treasuries, well, the picture starts to get a lot clearer. Because if you're wondering, well, why don't they just buy Chinese government bonds? Well, think about this. The yield on the 10-year CGB is somewhere around 1.7 to 2%. But what about the yields on the 10-year Treasury? Well, they're closer to 4%, meaning if there are rate cuts, you're going to get far more appreciation out of a Treasury than you're going to get out of a CGB. So if Chinese banks are dumping yuan to get dollars to buy short-term treasuries, then they can sell those treasuries for a higher price later on, and then they can use those appreciated dollars, however it is, whether it's from the actual dollar and the swaps going up or it's from the treasuries, well, then they can use those appreciated dollars to buy back more yuan and deal with the liquidity issues that are hitting the economy. And so what you're seeing here is a very clear indication that Beijing is quietly trying to bail out the banks, and the banks are betting big on the dollar. and perhaps for good reason. Because Powell reiterates no risk-free path from the Fed amid dual threats. And Powell said in a speech yesterday, there have been a marked slowing in both the supply and demand for workers, an unusual and challenging development. In this less dynamic, somewhat softer labor market, the downside risks to employment are risen. And so what does this tell us when we saw those big drop-off in new orders in the PMI? It's about to hit the labor market. So what you're clearly seeing is Chinese banks are making a massive bet because they know their economy is going to take a hit. But if the Fed starts to cut and they own some treasuries and they own some dollars, well, those are likely to appreciate in value. Now, Powell also went on and reiterated that interest rate policy was still somewhat restrictive. What Powell was telling the world, this is a very clear communication, and to the Chinese banks, buy treasuries, buy dollars, and buy lots of them, because when I cut rates again, well, your value of those securities are going to go up, and you can sell them for a profit, and that's exactly the motivation here. What we're seeing, my friends, is very clear signs that Chinese banks are preparing for a massive liquidity crisis, one that could be here within months. And while China's banks may be preparing for a catastrophe, something we're bullish on is the stock for our sponsor for today's show, Mindwalk Holdings. You can find them on the NASDAQ and the symbol HYFT. Everything you need to know in the pinned comment and description below. Because the whizzes at Mindwalk, they're revolutionizing drug discovery. Today we're zeroing in from their hottest update yet from just 2 days ago, a game-changing advance in weight loss and anti-aging meds. This could be huge for staying fit and useful longer. And Mindwalk's Lens AI platform just uncovered a smart connection between blockbuster GLP-1 drugs. Think Ozempic for weight control and a pathway to fight aging. They're crafting a first-of-its-kind dual treatment, a GLP-1 agonist teamed with a GIP booster. This combo aims to amp up fat burning while dialing down inflammation and boosting cell repair for real longevity gains. And imagine your weight loss med not just helping you drop pounds, but also keeping your energy high and body strong as you age. Mindwalk's design uses AI to tweak these drugs for longer lasting effects with fewer side effects. Early computer models show promise in hitting multiple targets at once, a step toward treatments that tackle obesity and aging head on without the usual trial and error headaches. And tying into this excitement, Mindwalk's latest quarter smashed records with a $7.6 million in revenue, a 45% jump year over year. They're cutting costs smartly and stacking cash for more R&D, just like this GLP-1 project. It's proof their AI isn't just innovative, it's profitable and scaling fast. And the GLP-1 sector is exploding, valued now at $53 billion, and set to grow at 70% annually through 2030 as more folks chase weight and wellness wins. Layer on the $60 billion longevity market by decades in, and Mindwalk's dual antagonist play positions them perfectly in this trillion-dollar health shift. And unlike pure AI players, Mindwalk blends their tech with it in-house labs and ready antibody pipeline. This gives them an edge in turning discoveries like this GLP-1 GIP combo into real therapies quicker than competitors. No one else has this exact anti-aging angle locked in yet. And let's talk about locking in. Let's take a look at their stock chart, because right now it's locked in and poised to go higher. And across your screen, you see that red line? Well, that is the 6-month volume profile where most shares have been traded. And right now it's acting as a layer of support, as you can see the stock holding right there. And we've talked about this in our trading program, how this is a catalyst to send prices higher. And my friends, this is one trade you don't want to miss. With this GLP-1 longevity push rolling forward via Lens AI, Mindwalk set to pioneer meds that redefine healthy aging. Revenue's climbing, markets are ripe, and this is innovation you can feel. Check them out on the web at mindwalkai.com and on the NASDAQ under the symbol HYFT. And as always with any company we feature on the show, you're under no obligation to purchase their stock. Be sure to do your own research and set your stop losses accordingly before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.